no strings attached. There are no balance requirements, so you can deposit as little or as much as you want. And Public provides up to $5 million in FDIC insurance, 20 times the standard average. So to recap, 5.1% interest with no fees, no minimums or maximums, and up to $5 million in FDIC insurance. Start earning that 5.1% on your cash at public.com.
This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Welcome back to Business Breakdowns. Today we are covering India's largest non-banking financial company, Bajaj Finance. Today, Bajaj has a market cap over $50 billion, which can largely be attributed to the significant growth over the past 2 decades. To break down Bajaj, I'm joined by Saurabh Mukherjea, the founder and CIO of Marcellus Investment Managers. Now, Saurabh previously joined us for a breakdown on Titan and returned to dive into this specialized lender. One of the headline numbers that immediately caught my attention from Bajaj is that the loan book compounded 40% from 2009 to 2022. But we won't just judge that book value by its cover here. We needed to dive into what Bajaj is actually capturing in the lending economy. And Saurabh gets us into the unique dynamics with India's lending system, how Bajaj embedded itself into the consumer durables purchasing funnel, and how this business has performed in various cycles. Regardless of how you interpret the loan book, it is fascinating to see how Bajaj has become this extension of manufacturers' sales forces. And there's a lot to learn here, particularly going into a new geography outside of the US to see how the lending system works. Now, please enjoy this breakdown, Bajaj. All right, Saurabh, thank you for coming back for round 2 of Business Breakdowns. I am excited to go back to India to cover a business there. The fans of Business Breakdowns in India are loud and vocal and always excited when we cover a name in India. Today, we'll be covering Bajaj Finance, a company that I knew very little about. I'm guessing many in our audience will also be unfamiliar with Bajaj, or BFL, as I'll likely refer to it throughout the conversation. So maybe we can just start extremely high level, set the scene for the company. What do they do? What do they sell? Any metrics around it to give a sense of the size of this business would be a great place to start.
Firstly, thank you for inviting me back. Last year, I did my first business breakdown. That was a lot of fun. So looking forward to this one. Bajaj Finance, BFL, as you called it. This is India's largest retail lending NBFC. So NBFC stands for non-bank financial company. Basically, this is our shadow lending sector. So BFL is India's largest retail lending NBFC. Majority, nearly 60% of India's consumer durable loans are made by this one company. And as we'll discuss over the course of this session, the competitive advantages really are around very low cost of funds, a uniquely intense work culture, and state-of-the-art technology. But before we get there, just to contextualize BFL, I'll sort of give you 3 dimensions to think about this. In the Indian economy, credit outstanding grows at around 11%. Over the last decade, Bajaj Finance has grown its loan book at thrice as fast, sustainably thrice as fast as the broader lending sector in India. The second way to contextualize it is just to think about the lending sector in India. Banks lend around $2 trillion in India. The non-bank sector lends around $250 billion. Bajaj Finance's loan book is $40 billion. So roughly 1 in 5 non-bank loans in India, 1 in 5 non-bank loans in what is the world's 5th largest economy is made by this lender. And the final way to contextualize Bajaj is just to look at the compounding. So over the last 16 years, this company has compounded share prices 1000x. That's underpinned by 30% loan book CAGR, 50% PAT CAGR. So 50% PAT CAGR over 16 years. I think that's roughly 650x PAT compounding over 16 years. So we're looking at an extraordinary lender which has achieved exponential growth in what is one of the world's fastest growing economies.
And to separate what would be a bank loan or the customer base for a traditional bank loan versus someone who would use BFL for that non-traditional loan or non-bank loan, can you just describe the differences in terms of the customer bases there or who they would be targeting?
So what Bajaj did very well, and I think a lot of the credit for this goes to my erstwhile neighbor, who's the CEO of Bajaj Finance, Rajiv Jain, is really the transformational figure for Bajaj in the last 16 years. So the area that Rajiv and the owner group at Bajaj Finance identified was aspirational Indians, Indians who want to upgrade their lifestyle, but for whatever reason can't get a loan from a bank or can't get a credit card from a bank. And the core customer acquisition engine is to give working capital loans or consumer durable loans to these upper middle class or middle class aspirational Indians. Bajaj Finance does this through 100,000 consumer durable stores, I would say in excess of 10,000 auto showrooms. It's an app which has been downloaded by over 50 million Indians. And just to put it in simple terms, I reckon there are at least 200,000 venues in India where you can get a Bajaj Finance loan. And the lending product itself is unique. And then this is really the innovation that made Bajaj Finance a giant compounding engine. The mainstay product is called a no-cost EMI. So EMI stands for equal monthly installments. And this is a consumer trying to buy a TV or an air conditioner or a fridge. And he rocks up at the local consumer durable store. And let's think about a consumer who wants to buy a fridge. The fridge costs $1,200. Bajaj says, no problem. You don't have to pay upfront for the fridge. We will lend you the money. And guess what? You don't have to pay any interest on this. This was a mind-blowing innovation. In fact, even when I heard it from my erstwhile neighbor, the now CEO, I could barely believe it. I first heard about this 12, 13 years ago. I thought there's a catch. How can you make money? So I'll quickly explain how this $1,200 fridge loan, where the customer doesn't pay any interest, makes money. Effectively, the manufacturer of the fridge, assume Samsung here. Bajaj will pay Samsung not 1,200. Bajaj will pay Samsung 1,200 less 5%. So in this case, $1,140. That 5% is the marketing discount that Samsung is basically giving away to Bajaj. The customer will pay a small upfront fixed fee. And even though the customer is paying $100 times 12 and just repaying the $1,200, that 5% marketing fee that Samsung has paid Bajaj results in a 20% plus IRR for Bajaj. So it's a win-win for everybody. Samsung shifts its fridges quicker. The customer gets to buy the fridge without any payment upfront and zero cost financing. The retailer couldn't be happier. The stuff is flying off the shelves. And Bajaj acquires a middle class, upper middle class aspirational consumer with a low risk product on a small ticket loan. This is the customer acquisition engine. Nobody else has been able to do consumer durable lending on this scale. And this is really what Bajaj has come to be identified with.
And in that example, can you talk about the timeline for obvious collection is coming from the consumer in monthly installments? When does that transaction between the manufacturer of the refrigerator and Bajaj take place?
So right up front, so the moment the consumer presses the buy button, Bajaj is transferring $1,140 to Samsung's bank account. And the $60 is effectively a marketing incentive that Samsung has effectively given up to Bajaj. So if you think about it, Samsung is getting paid right up front. Bajaj is getting paid over 12 months. But because it's a small ticket loan and the whole process is highly automated, there's barely any human intervention. Even the loan underwriting decision is highly automated. Bajaj's marginal cost of collecting out is actually quite low. And if you ask me, the big insight that Rajiv Jain, the CEO, had 15, 16 years ago is that aspirational Indians will not default on this fridge loan because this is a gateway for them to other goodies. If you mess up on this loan, your credit score gets ruined. And as it is getting a credit card from a bank, Bajaj Finance is giving you a gateway to further loans and indeed cross-selling and upselling to the customer. The typical customer gets upsold and cross-sold 6 products. Cost of acquiring a customer is low because they're coming to the consumer durables loans. But even more interestingly, a repeat customer costs Bajaj 1/10 of a new customer in terms of operating cost, and the credit cost in terms of credit risk. The repeat customer credit risk is 1/3 that of a new customer. So cross-selling and upselling, that engine, again, I don't think anybody has built it quite as efficiently as Bajaj has done.
There certainly seems to be some benefits to scale here. And I think with a credit related business, that often takes time. You've referenced Rajiv's importance to this business, but maybe we can go back. I know this started prior to Rajiv. Tell us a little bit about the origination story, the founding story, and some of the key players that have played a role in the business as it's grown into what it is today.
So other than Rajiv, there are three other key characters in this drama. So the late Rahul Bajaj, he was the founder of the group Bajaj Auto, the group that Rahul Bajaj really drove through the 70s, 80s, 90s, was India's largest two-wheeler manufacturing group. Rahul Bajaj is really a JP Morgan-esque figure in Indian industry. He was a member of parliament. He championed India's development through the 70s, 80s, 90s, and he's really a pivotal figure for Bajaj Finance. The second important person after Rahul Bajaj in the family that we need to look at is Sanjeev Bajaj. Sanjeev is Rahul's son. Sanjeev now is the chairman of Bajaj Finserv. Bajaj Finserv is the largest shareholder of BFL. So Bajaj Finserv owns, I think, 51% of BFL. And Sanjeev really is the owner, man representing the ownership interest today. Rajiv Jain reports into Sanjeev Bajaj. And the third figure is a very interesting man. His name is Nanu Pamnani. Unfortunately, he passed away a few years ago. The late Nanu Pamnani is a relative of the Bajaj family. He was a star in Citibank in the 80s and 90s. Rumor has it that had he agreed to move to New York, he would have ended up running Citibank. But hey, we in India are very fortunate. He didn't go to New York. Instead, he moved to Pune and he became a mentor to Sanjeev Bajaj, the current owner, and Rajiv Jain, the current CEO. So he's the Machiavellian strategist who helped Bajaj come up with this business model. So these are the key figures. The origin story, Matt, is in 1986. So just to paint the picture of 1986 India, I was in secondary school then. The country was dirt poor, but there were two things that were doing well in India in the mid-80s. Everybody seemed to want to buy a two-wheeler. Bajaj was the market leader, and everybody wanted to borrow some money because we didn't have that much money in the 80s. We were a really poor economy. India was dominated by government-owned banks in the 80s. The government-owned banks were, guess what, lending to the government. And the only other people they would lend to is whoever else the government wanted to curry favor with, such as, say, farmers, because farmers are a big vote bank. The government-owned banks were not interested in financing two-wheelers. And Citibank was one of the few foreign lenders. Citibank was one of the few foreign lenders operating in India in the 1980s. They obviously saw an opportunity. So they reached out to Bajaj Auto being the parent company. And they said, what if we finance some of your two-wheelers? The Bajaj Auto guys said, that's a great idea. And these guys spread out across Pune. Pune is the city 150 kilometers southeast of Mumbai. And the Bajaj Auto team spread out in the factories and warehouses of Pune, saying, Citibank is happy to give you an auto loan to buy a two-wheeler. Would you like some of this? Now, surprisingly, when they went to the Tata Motors officers' mess is a place where the officers relax in the afternoon. The Tata Motors officers were all very clever engineers. They did the maths and said, hang on, this interest rate is looking a little steep to us. We don't think we're interested in this. Thankfully, somebody in Bajaj Auto had the brainwave to say, forget the officers. Let's go to the factory. Let's go to the workers' canteen in Tata Motors' Pune plant. And that's where the workers took to the Bajaj Auto scooter financed by Citigroup. In fact, the response was so enthusiastic that Tata Motors allowed the Bajaj Auto team to come for 3 consecutive days to finance these loans. And I think in 3 days, they sold 2,000. They sold 2,000 scooters on auto finance from Citibank. And thus, the beta testing was done. Subsequent year, Bajaj Auto Finance was created. Unwittingly, Citibank had done a beta test for what has become one of the most successful lenders in the bank. So that was the inception story. 87 is when the company begins.
Did Citibank maintain any economic interest or any type of partnership with Bajaj into the future?
Not that I know of. Remember, the other Citibank link is Nanu Pamnani, the late Nanu Pamnani, who was a big wheel in Citi in, I think, their Asian operations, ends up joining Bajaj in 2007 as a mentor. But in between the origin in 87 and Nanu joining Bajaj in 2007 as, I think, the vice chairman, in that interim 20 years, Bajaj Auto Finance took off. I think Citibank had its parallel lending business. Citibank continued doing consumer, durable, and two-wheeler finance on its own steam. Ironically, until the Lehman Brothers crash in 2008, at which point Citi stopped doing all of this stuff in India. And that Lehman Brothers crash, Bajaj Auto Finance also suffered. I remember I just arrived in India at that juncture. And I remember non-performing assets for Bajaj went from 2% in 2007 to 12% in 2009. So 6x jump in NPAs. Liquidity had dried up across the world, including in India. Defaults rose and NPAs went 6x. And the return on equity, which used to be a healthy 25% in 2007, fell as low as 1%, Matt. By 2009, I think ROE was down to 1. So this is the pivotal point. So 87 to 2007 is uninterrupted growth. Then Lehman Brothers disrupts the story. Nanu arrives at the request of the patriarch to basically mentor the new CEO and the patriarch's son. And then this troika really constructs the business model that we know Bajaj Finance to be, the consumer durables business model, the zero cost EMI business model. And in that regard, I think Lehman Brothers was a blessing in disguise. Had Lehman not happened, had Bajaj's profitability not got crushed in those 2 years, I don't think the reinvented Bajaj Finance would have been born with quite the vigor that we see in the firm today.
There's a few things that I wanted to hit on there. One of the things that stands out about the key members of this story is that they seem to have this family relation. And I'm curious if that's common in India to see so many of the key players end up being family related in these businesses, or if that feels somewhat unique to BFL.
So family-run conglomerates still dominate the industrial landscape in India. Broadly speaking, you have two family-run conglomerates in India, Matt. One is the Tatas or the Mahindras. There is a founding family, but there are very few active family members left in leadership roles. So in the Mahindra empire, for example, none of the founding family members are active participants in the business. And actually, even in the Tata family, barring one or two members, nobody's an active part of the colossal empire that the Tatas run. And the second type of Indian conglomerate is like the Bajaj conglomerate, where the family members are very active. They're making critical capital allocation calls. Reliance Industries is also very similar. Family members are active. So we really have both in India. The origins of this go back to the fact that we were a very capital poor country. Until 20 years ago, capital was scarce. And therefore, if a business happened to have some profits, recycling those profits to build out a conglomerate was the best use of capital. Raising capital from the broader financial system was a cumbersome and high cost affair, and thus the rise of the Indian conglomerate.
The cost of capital advantage, I think for many US listeners, coming from a 15-year period with very easy access to money, it is lost. And we've seen conglomerates certainly fade in terms of the relevance versus where they were many years ago. But I think that story certainly rings true when we look at history. The other thing that I was curious about is you mentioned they took this, what was intense downturn, and it turned into a great opportunity for them to pivot or evolve the business model. Just looking back at that period of time, it seems like the type of event that could have easily brought them down in terms of their exposure. Did they require any type of bailout, rescue funding, or was it run with some type of appropriate leverage levels on the overall business, which allowed them to escape?
So there was an equity raise. I remember 6 or 7 months after Lehman went bust, there was an equity raise. There wasn't any government bailout. What I think saved them from a financial standpoint was not only are they an NBFC, they're a very rare type of NBFC. They're a deposit-taking NBFC. That means, Matt, like a bank, they can approach the public for time deposits. Now, the Bajaj family has a very good reputation. Notably, they've never defaulted. So because the family's reputation is so stellar, Bajaj Finance Limited, BFL, was able to raise debt finance in the wholesale market and in the retail market, courtesy the holding company's stellar reputation. Without that, I think raising debt finance post-Lehman would have been, I think, close to impossible. I remember 2009, raising debt finance in India was tough. So there was an equity raise, but there was no further bailout required. And to this day, the fact that Bajaj Finance Limited has a deposit-taking license and the Bajaj name gives them the lowest cost of funds of any NBFC in India. They basically get money at 7.5%, 8%. To Americans, that might sound like a very high rate, but just remember the Indian 10-year bond yield is 7%. So this company is raising money at 100 bips over the sovereign, and that money is then the engine for all the clever lending that they do.
And I think we talked a good bit about what their customer base looks like today. Getting into what is ultimately required with these businesses, which is how they actually go about underwriting, a little bit of the go-to-market, which you've described. But can you talk through that model, which seems to have really differentiated from competitors and given them this advantage relative to anybody else in the space?
So let me begin by focusing on what I think is their true competitive advantage. Effectively, Matt, this is a tech company in the guise of a lender. The reason I say that is, so I arrived in India in 2008. At that time, I realized that Rajiv Jain owns a condo next to where I live in Mumbai. And at that time, they were like any other lender. BFL then used to rely on credit bureau data. Our largest credit bureau is called CIBIL. This is the Indian equivalent of Equifax. So BFL used to rely on credit bureau data. somewhere around 2010-11, they hit upon a construct where they would use sample sizes of 10,000 customers to experiment with different underwriting models. So let me give you an example to explain how this works. India has around 1.2 million doctors. So 2010, 11, 12, I won't be able to tell you exactly which year, but somewhere in that era, Bajaj Finance experimented with roughly 10,000 doctors. They lent to 10,000 doctors. Doctors typically in India need working capital loans to grow their practice. And Bajaj Finance started stratifying these 10,000 doctors into 600 buckets. And the buckets could be based on things like, has the doctor gone to a leading med school such as the All India Institute of Medical Sciences, or did he just go to the med school down the road where he gave a donation to the principal to get a place? Secondly, is the doctor an oncologist or is he a general physician? Is the doctor's clinic, is it in a very affluent part of town like Malabar Hill in Mumbai, or is it in the back of beyond? So if the doctor's an oncologist from the top med school and has a clinic in the best part of town, then Bajaj said, let's give him a loan at a super low cost. And vice versa, if it's a doctor which looks a little ropey. This construct gave them two benefits. Over time, they played around and experimented and nailed down the metrics which drive an ideal doctor loan. But what it also did was the lower quality doctors, the higher risk doctors, were weeded out of the portfolio. They found that they could get cheaper lending elsewhere, and the book cleansed itself. The book almost self-corrected away from high-risk doctors. Now, these data points, I gave you 3 data points, the med school, location, and the doctor's area of specialization. Today, Bajaj Finance uses 1,000 data points on each customer to make the lending decision. This is all automated. Rather than 1 million doctors, they have 200 million Indians in their database. So if you just do the math on that, 200 million Indians times 1,000 data points, Bajaj Finance's database has 200 billion data points inside it. This data lake is getting churned every day. And especially when we get to festive season in India, our equivalent to Christmas is Diwali, the data lake almost explodes. As a result, Salesforce, which is the analytics and CRM provider to Bajaj, we hear that Salesforce has a separate database entirely for Bajaj Finance. And from what we understand, this is the only lender in the world that Salesforce treats in this manner. This really is the heart of the Bajaj Finance competitive advantage. To run this data lake, they hire dozens of graduates from India's top engineering colleges, which is the Indian Institutes of Technology, computer scientists, electrical engineers, data scientists. It's a vast team. I think the headquarters building alone, they have 1,000 data scientists and electrical engineers working on this vast data lake. So this is the first competitive advantage. It'll be really, really difficult for someone else to build this because you got 200 million Indians, thousands of data points, and years of experience of how to mine that data. The second aspect of what's very hard for others to replicate is the culture. So I found out about this around 7 years ago. I first invested in the stock and I'd gone to meet Rajiv, my erstwhile neighbor, now the CEO, to understand how the company was doing. And his office executive assistant called me to say that the meeting will be at 7 o'clock. So I said 7 p.m. She said, no, 7 a.m. And I was a little taken aback, but then I realized that that's when everybody starts work in Bajaj. In fact, they start working Bajaj Finance at 6:45 every day. It's a 65-hour work week. Everybody is told it's a 65-hour work week. And if you can't deal with that, please move on. So the motto is do more, earn more. And this aspect, that it's a driven culture, everybody from the CEO down to the youngest graduate will do a 65-hour work week. I suspect actually they do far more. 65 is the message that we get. Now, alongside this, every month, employees are eligible for a bonus. So 90% of the workforce gets a variable incentive every month. These incentives are again coded. This is a highly metricized reward system. And at the end of every month, there's an auto credit of your month's bonus basis your performance that month. And that was already agreed with you at the beginning of the year. Now, you'd think that this ruthless, performance-oriented culture will result in high attrition, but you'd be surprised. Attrition is actually 15%. The typical employee works here for 6 years. Part of the reason is they earn way more than what they would at a competing lender. And the final bit of the culture bit, and this is very unique to India, firms like Danaher, GE in its pomp probably had this in America, but what they have done, and unique to India, is every year there's a 5-day long-range planning process. From what we understand, they go away to a mountain resort, they hike and climb mountains, and in between, they strategize about the next 5 years. And they'll look at globally successful companies like Microsoft or Netflix or Amazon, and they'll say, what can we learn? How can we strategize? That 5-year LRP is then the spine that gets updated every year. I haven't seen any other Indian firm plan as strategically. Those LRPs then give you the metrics on which the incentive payouts are done. And the thing is, the long range plan gets drilled down the most junior, most employee through the incentive construct, which kicks in every month. And the final piece is geographical reach. I already mentioned that 100,000 consumer durable stores, tens of thousands of auto showrooms, 52 million app downloads already. If you are a new consumer durables player, LG, Samsung, Sony, you want to make it big in India, you have to pick up the phone and call BFL because this is your plug and play into the Indian customer ecosystem. But it's not just scale. The typical BFL loan is given in 90 seconds. So I live in a reasonably affluent part of Mumbai. If I go to the local consumer durable store, there'll be BFL's lending desk and some of India's largest banks and non-banks. Everybody else barring BFL will take a couple of hours for that consumer durable loan. BFL is 90 seconds. The reason for that matter is they've already credit assessed the customer long before the customer walked into the store. Now, you as a new entrant into the Indian market will say, I want reach. I also want most people to get the loan. Otherwise, how will my product sell? I don't want the customer to have to hang around. I don't want a high rejection rate. It's very difficult for anybody else to provide that plug and play. And thus you create a virtuous cycle. All the players who want to sell their goods in India come to Bajaj Finance. Bajaj Finance finances more and more customers, more and more data, more analytics, better informed algos, lower credit costs, and thus the virtuous cycle spins away.
There were so many great details in that differentiation and what goes into it. I have to mention we are recording this at 8:30 p.m. India time on a Friday. So you've taken something from their culture and certainly applied it to yourself, which I appreciate. One of the earlier points you made was on the cleansing of the portfolio. And just to get a sense of how this works with underwriting, is it a binary decision where it is a yes or a no? Or does it extend beyond that in terms of the rate playing a role on the back end if there's delinquent payments? How much variance is there in the underwriting process?
It's not a binary decision. They are basically risk pricing. And Matt, if you think about it, they're risk pricing across three different dimensions. As you rightly picked up, for a given customer, so go back to the doctor, the star oncologist in affluent suburb of Mumbai will probably get the lowest rate, but the GP in the boondocks will still get a rate, albeit a higher one. So there's differentiation across a specific set of customers. But there's two other differentiation. The way Bajaj runs the business is there are 40 different lending heads. So 40 different products. Each lending head basically runs a mini company. So he'll have his net interest income, his fee income, ROE, ROA, the whole 9 yards. The more successful the divisional CEO is, the more capital she will get from the corporate center. So the corporate center is saying, hey, I will give you more money if you can show me growth at a really good ROE. And I'm also tracking your risk metrics, by the way. Secondly, each CEO can discriminate across customers. And thirdly, within a specific product. So for example, within home loans, the CEO can say, I reckon this is not a good time to be giving home loans below $20,000 ticket size. Let's ramp up on home loans above $100,000 ticket size. So there's differentiation within a specific segment of customers. There's differentiation across different parts of the business. And there's differentiation across subsegments of a specific industry, such as home loans. The ability to allocate capital on the fly in a giant economy at hyper speed. Remember, the book is growing every 2.5 years, the book is doubling. So the ability to put all of this on an industrial scale is, again, a critical skill. And effectively, they're making millions of capital allocation decisions every year. And by and large, those capital allocation decisions are working out.
And in terms of managing that risk, are they able to work with the manufacturers at all to assume some level of that risk where rather than getting 5% discount to the list price, they might get 6% or 4%, something along those lines where there's an adjustment, or is it all being managed on their own books?
So at the store level, I'm not so sure whether there is a variable discounting policy with the manufacturers. But what we do know is in their online proposition, they've got something called the Bajaj Mall. It's an online store. You can buy durables, auto, all manner of electronics. And one of the things we can see there is roughly on 1 in 3 products, and 1 in 3 products sold on the Bajaj Mall, you can get prices lower than Amazon or Flipkart. And we did some work to figure out how this is working out. And what we figured out by talking to some of the auto companies whose products are being sold on Bajaj Mall is Bajaj's algos tell their lending heads, for example, how many 600cc mountain bikes will be sold in the next 30 days. So they will go to the manufacturer of that 600cc mountain bike and say, listen, we're going to sell 20,000 of these. Can you give us a lower price than is available at any showroom in the country? And can you also ensure that the price is lower than what you offer anybody else, Flipkart, Amazon, whoever? And as a result of that, as a result of them being able to predict, Bajaj is predicting how many people will buy high-end phones and cars and bikes. They're using the algo to negotiate a bulk discount. And as a result of which, their online mall, the Bajaj Mall, has premium products available at discounted prices. So that's where we've seen the discounted kick in. I'm not so sure at the store level, they've got variable discounting going on with the manufacturers.
Very interesting point, though, and the way that they can play around with the scale advantages that they have. And ultimately seems to be an extension of the sales force of these manufacturers in many ways, and in a very, very impressive fashion in terms of how they can drive a lot of that. On the culture point and the willingness for the workers to put in this time, you mentioned the monthly bonus payments. Is that unique to this business? Is that fairly common in India to see something? I think in the US, we see quarterly in quite a few sales positions, but monthly is very unique.
I think many parts of the Indian financial ecosystem will have a monthly bonus culture. What's unique is the metricization and the fact that human intervention is not driving the monthly bonus payment, that it's algos driving the whole thing. So the stockbroking sector, for example, in our country, many parts of the banking ecosystem, the credit card industry, there will be monthly bonus payments unquestionably, but most cases there is human intervention. I think what Bajaj has done, and quite deliberately so, is made it very transparent and thus made it obvious to people that if you're an ambitious young professional who wants to rise in the financial services world and you want to get rich reasonably quickly, this is the employer of choice. So I've seen whenever I go to their office, the average age of employees will be south of 30, hungry young people. And when we have traveled around India, Matt, when we've gone to smaller towns in India, the town head will be typically a 28, 29-year-old, 3 or 4 years out of college, hungry young man or woman, pushing himself hard to make sure that those incentives click in into his monthly pay.
On the geographical reach and the expansion within India, I think one of the takeaways from our series, Return on India, and just what you described earlier, population is basically 20% of the globe. It's not homogenous. You have different areas, different cultures within those areas, different demographics, particularly on the wage side of things. As they've expanded, have they hit any bumps in the road as they've gone into more and more of the geography? How has that expansion gone? And have there been any hiccups along the way?
So look, I'm sure there have been geographical hiccups. I think for reasons of political sensitivity, they probably don't make those public. So for example, the eastern side of India is lower income and lower growth than the west and the south. In fact, the south of India is almost twice as rich as the rest of the country. And therefore, as you can imagine, west and south, Bajaj has had far more traction. Some of the poorer eastern states, I reckon their footprint is weaker. Where I think they've been able to, and this is both a forward-looking point and I think a point about the last 3-4 years, where I think they've got a real tailwind behind them, is the rise of mobile data in India. So 2016 is when Jio launched its incredibly cheap mobile data plans. Basically, the cost of mobile data in America is 40x what it is in India. So we in India get incredibly cheap mobile data. And Bajaj Finance realized that as mobile data gets cheap, Indians will take to their mobile phones. So around 3 years ago, I think at the height of the pandemic, they pushed themselves really hard to launch their app at the height of the pandemic. And that resulted in 50 million plus downloads. Interestingly, they didn't spend a single dollar on marketing the app. Without marketing the app, 50 million downloads. And the Bajaj Mall and the app interplays. The app not only has lending, it also has the mall. I think they also have stockbroking on top of it. India is adding roughly 10 million to 20 million new stockbroking customers in the Indian market every year. So you're seeing the creation of an online financial services giant in the space of 3 years. And not only is it stockbroking, not only is it the Bajaj Mall, not only is it lending, but it's also a payment app. Their Bajaj Pay app has been very successful. A decade or so ago, the government launched a variety of initiatives which have resulted in something called the Unified Payment Interface. Basically, half of Indian GDP now works on Indians paying each other using their phones, using UPI. But to access UPI, you've got to go through an app. So Google, for example, has a very successful app. But Bajaj Pay has also scaled. My reckoning is the largest fintech player has effectively become Bajaj Finance, and they've done so really quietly without any burn on marketing at all.
The 50 million app downloads. We have Tinder in the US for much different reasons, but I think you could tie all of these things to various needs of people that gets ingrained in us. One last point on the things you described, and you've touched on it a few times, the importance of the physical presence in stores and pairing that against that app presence, which I think you pointed to, and particularly during the pandemic, why it was so important. As you look into the future, I don't know if you have a sense of what percentage of business is now done through the app or online versus in store or on site. But any sense of what that looks like as a split, and then just your general sense of where you expect those to trend over time?
I think starting with the in-store presence, both with the local consumer durables store near my house and in general across India, I've seen that the in-store Bajaj Finance guy or girl basically does two things really well. Firstly, they will urge you to upsize your products. So if you're buying a 32-inch TV, why a 32-inch TV? Surely you look like a person who could do with a 42-inch TV. And again, that's a win-win for the retailer and for the OEM. And the second thing is, once they've realized that you've bought as big a TV as you possibly wanted to, they will start the process of cross-selling the Bajaj Finance products. So, Matt, I see you've taken a TV loan. Do you know we have an extremely attractive offer for car loans? Here is our app. You might want to look at the car loan offers on that. So the in-store customer acquisition is both driving up the ticket size of that loan and then beginning the upsell journey for further loans. The amount of share that the Bajaj Finance desk in a store will have will be somewhere around 70-80%. I live in an affluent part of Mumbai where you think people won't need a loan to buy a fridge. But I go to the local durable store, they tell me that 90% of consumer durables are bought using credit. And out of that credit piece, 80% is Bajaj Finance. And therefore, you get numerous opportunities to upsell and cross-sell to affluent people. Coming on to the online versus offline piece, online isn't still a meaningful part of the book. The online piece is still, I think, business development, where they're building out their key assets. If you hark back to the 2008, 9, 10, 11 era, they basically tried and played and experimented for 4 years before they hit the accelerator. So 2008, 9, 10, remember I was describing the 10,000 doctors and how they experimented. I reckon there's a heck of a lot of experimenting going on. The reason I suspect that is, over the last year, the amount of automated calls that I get from Bajaj Finance and the automated messages have stepped up. And I keep reading these messages. And as an investor, I'm very interested because the messages, our formats change, the ticket sizes change, the interest rates change. So I reckon there's a whole bunch of tech work going on using the app, using the payment app and the mall to figure out how best to optimize. And again, that's a sign of what I think is a very successful company. No decisions made in a rush. Experiment with small ticket sizes, small amounts of money at stake. Once you're completely sure that you've got it nailed, that's when the cannonball, that's when the ramp up will come.
Makes a lot of sense. Transitioning a bit to the financial model with banks or with lenders, it can always be tricky to paint the picture relative to traditional operating companies. How do you frame the business, particularly from a financial model standpoint?
So the flow through of numbers is reasonably straightforward and it's been very stable for the last 15 years. So roughly, let's start with the $40 billion. That's the loans outstanding. That's the asset base. And I'm going to express everything as a percentage of this 40 billion. So net interest margin is 10%. Nobody else in India makes a 10% NIM and you're operating on a Colossus scale, 10% NIM, then 2% fee income. Remember the zero cost EMI, there's a fee involved. The 2% fee income kicks in there. So you're making roughly 12% from the customer. Knock off 4% for OPEX, 1.5% for provisions. Again, nobody of this scale in India has as low a provisioning cost. So you've knocked off 4% OPEX, 1.5% provisions. You're left with 5.5% of PBT. That translates into PAT of 4.5%. You lever that PAT 5x, you get to an ROE of 22%. Just 5x leverage. Amongst the big lenders in India, this company operates with the lowest leverage and yet generates the highest ROE. So 4.5% PAT resulting in 22% ROE. If you multiply that 4.5% PAT with the $40 billion loan book, you get to the current profitability, which is a shade under $2 billion. That flow through of numbers I gave you, Matt, 10% NIM, 2% free income, 5.5% PAT. Nobody in India operates on this scale with those numbers. These are unbelievable numbers. Beyond the other aspects we've discussed, which underpins this company's success, there's a few other things. This is a very lean operation. There's no marketing cost. There's no big spend on advertising. Customer acquisition costs are low. And just to give you a sense of how lean these people are, I remember it was around 7 or 8 years ago, they had a consumer discretionary finance loan agreement that used to be 10 pages. They applied their mind to it and figured out how to get it down to 3 pages. that detail across millions of loans helps save cost. So low acquisition cost, low marketing cost, high interest rates, high NIMs, and an extremely profitable business with a DuPont, which no other lender in India has been able to match.
One of the things that when you were first describing the business, I expected to happen was you had these customers that maybe didn't qualify for traditional credit. But what I expected is at some point in the future, they would graduate and maybe move out of being a BFL customer into being a traditional credit card customer. What you just described there, in terms of your neighborhood and the amount of loans that are still done through Bajaj, it doesn't seem to be the case. Is that something, just thinking about the churn or the maturity of the customer base and whether they actually transfer out of BFL? Can you describe whether it is surprising in the sense that they do retain many customers, or if that is one of the dynamics that takes place and they have to basically replace those customers in the future?
So I'm sure there's a upgrading of customers that is happening, but the funnel is also feeding in millions of new customers. And my reckoning is that somewhere around 5 to 10% of the book is balance transferring out and a larger number is coming in. Now, there's a very clever thing that the Bajaj management started doing 12, 13 years ago to manage this. Remember, I mentioned the 40 business heads that they have. The businesses are broadly segmented into two groups. The scale builders, businesses which are scale builders. So, for example, housing finance is a scale builder. A scale building business will have relatively low ROEs. The risk is low. It's supposed to be a low risk, low ROE business, but it allows Bajaj to build colossal scale. And then there are profit maximizers, businesses which are higher risk, but will generate juicy ROE and thus keep the ROE high. So what Bajaj does is basically combine the scale builders and the profit maximizers 50-50. Now, just to help explain why this is relevant. If you know that in housing finance, in home loans, there is a natural tendency for customers to refinance onto a lower rate loan. But if you know that, you keep your home loan rates very competitive. As it is, Bajaj Finance has the lowest cost of funds NBFC sector in India. Over and above that, you're effectively able to cross-subsidize your housing finance business, for example, with a microfinance lending operation, which is lending at 22-23%. So you're minimizing your balance transfer out risk by your low cost of funds, but also by having elsewhere in the Bajaj Finance empire, high ROE businesses in niche sectors such as microfinance, such as CV finance, and so on and so forth. And every year, what we see is they blend the two. So from what we are seeing, they're planning to bring two-wheeler loans. Two-wheeler loans will be 20% ROE, high risk loan, but alongside two-wheeler loans, which are higher risk, they're bringing in new car finance, which will be lower ROE. New car finance is a highly competitive market. It'll probably be a 12% ROE business. By constantly blending the high risk and the low risk, they're able to make sure that the low risk customers don't BT out any more than they absolutely have to.
The natural transition from everything in the financial model is to the capital allocation. And again, with finance businesses, capital allocation is different. A lot of that capital gets recycled into new loans. How do they treat capital allocation, particularly with the addition of thinking about shareholders, leverage dynamics, anything else that comes into play for this business?
So what we have seen over the last decade or so, and it's also taken a little bit of time to piece together exactly what they do, because as you can imagine, they don't want to share all their secrets with third parties in the world outside. This LRP process that they undergo every year, somewhere in autumn, October, I think, they go through the long range planning process and they hit upon these 5-year goals that they want to attain. Typically, from what we can see, Matt, they are hitting their 5-year goals every 3 years. Now, the 5-year goals tend to be around trebling the business over 5 years. But rather than trebling the business over 5 years, we're ending up seeing that often they're able to double within 3 years. And by the time they get to the 5-year mark, it's well over tripled. Now, that pace of growth is sustainable because even though it's a $40 billion lending business, credit outstanding in India is 2.3 trillion. And therefore, it's a 1.5% market share. What these guys seem to be targeting is they want to get to 2% market share, I think, in the next few years. In order to do that, every year, they're saying we will open some businesses which are scale builders. So I gave you the example that they seem to be going through a process of opening a new car finance business. And alongside that, every year in the LRP, they say we'll also open some businesses which are profit maximizers, the two-wheeler business example. Another combination of scale builder and profit maximizer that I think they're targeting is corporate loans. Corporate loans, because their cost of funds is so low, they can enter an area which has historically been dominated by banks in our country. banks tend to have lower cost of funds and naturally dominate corporate loans, but Bajaj is exceptional. So I think they're targeting corporate loans. They seem to be aiming for a 10% return on equity on corporate loans. But just to make sure that that doesn't drag down the overall ROE, they're combining corporate loans with microfinance at 25% ROE. So this LRP process every year in October says, here's the Mount Everest that we will climb in the next 5 years. Given the aggression in the business, they seem to get there in 3 years. And those strategic initiatives are around combining every year a bunch of new businesses around scale and a bunch of new businesses around profit maximization. Headquarters runs that process. So very similar to, say, a Constellation Software or a Berkshire Hathaway, where headquarters is doing capital allocation. And at the ground level, each of those CEOs is running after the metrics that he's promised to deliver at the LRP.
With an initiative like corporate loans, I certainly could understand where that puts you in a different playing field from a reputational standpoint, almost from a prestigious standpoint. It seems to represent something different. But I could also play devil's advocate and say, this is going to be lower return and it moves you away from your major advantages in many ways. So is this the right focus to have into the future? What are your thoughts just in terms of something along those lines and the positives and negatives related to something like that?
So it's a valid point you've raised. A decade or so ago, when they entered home loans, I was similarly concerned, a little bit perplexed. My point was, what advantage do you have relative to the then dominant non-bank home loan provider, HDFC? But we've seen in due course that they've built one of the largest home loan books in India. In fact, I think there's talk now that they will IPO, they will demerge their home loan business. It's become so big. So we've seen Bajaj Finance do this. Identify an area that they're targeting, identify a leader, usually from within, give the leader a capital budget, not expect the leader to generate astonishingly high ROEs. Their home loan ROE is significantly below the overall ROE of the business at 22%. So similarly with corporate loans, provided their ROE targets are realistic, and I'm pretty sure they'll not try to do more than 10%, provided their ROE targets are realistic, provided the Bajaj family's clout and reach into the boardrooms of the country, and provided this firm's ability to underwrite sensibly, I think there's a good chance of building scale here. Profitability is not something that'll come. And in order to prevent profitability from being compromised, they need that microfinance initiative to fire. So we doubted for a long period of time, till 6 years ago, basically, I was a doubting Thomas on Bajaj Finance, saying, how can you pull off so many different things in parallel? But by decentralizing decision-making, by pushing authority down the line, by giving transparent incentives to hardworking, bright professionals, they've shown that you can build a lending conglomerate that can be, if not all things to all men, then lots of things to plenty of people.
And one of the important dynamics, it seems like in India, the private sector and the public sector do seem to have a tight relationship just in terms of the initiatives to drive growth and evolution of India as a whole. And I can certainly see why BFL has played such a large role in that and what they've done with their traditional strategy. Can you talk about that relationship that they have at the government level? And also, do you see ever any risks as they transition into a conglomerate lender, maybe moving into areas where they're more competitive with existing solutions? Just anything along those lines as it relates to positives or risks with the business?
So I think let's link this to the corporate lending point. We haven't had a proper corporate lending cycle in India, Matt, for now nearly 8 or 9 years. So the Indian corporate lending ecosystem ran into a lot of credit and NPA related issues around 2014, 15, 16. And it's only over the last 2 or 3 years that the economy has pulled out of that mess. So the government obviously is very keen that project finance, corporate lending gets going, private sector capex gets growing. And in that context, I think the powers that be in New Delhi will be delighted to see Bajaj Finance also stepping into the corporate lending arena. If not anything else, it'll spur the banks on to do more in the corporate lending arena. Where I think both the most tricky interface for Bajaj Finance with the authorities and their most important regulatory interfaces with the Reserve Bank of India. So the RBI is our regulator, RBI is Bajaj Finance's regulator. And in RBI's case, they are very focused not just on credit quality, which for the Bajaj Finance people is not an issue, but they also focused on consumer interests. And this is increasingly I think, a fragile area for all lenders in India. As the economy gets bigger, as a rapidly growing lender like Bajaj Finance pushes the envelope, there are inevitably areas of friction with the regulators. So just to give an example, I think around 6 months ago, 6 months ago, the Bank of India said that they had found a couple of digital products where in Bajaj's key fact statement, there were some gaps. And the regulator's norm in India is to put up an announcement on its website saying we have hauled up XYZ lender for ABC reason. And Bajaj Finance received that treatment 6 months ago. It knocked off good 300, 400 bips of their EPS growth. So their recent results, EPS growth was only 21%, would have been easily 25% had the regulator not hauled up Bajaj Finance and made them stop lending on those digital products. Fortunately for Bajaj, they've corrected the gaps that the regulator identified. And last week, I think lending has started again for those digital products. I think this is where the relationship will be delicate. The Reserve Bank of India is saying we want lenders to treat customers fairly, whether it's on digital products or on apps. And there's a lot of gray areas. This economy is growing fast, and anybody who's found wanting on consumer fairness is getting hauled up by the regulator. These are smart people at Bajaj. I'm sure they'll not just fix the issue that was raised by the RBI 6 months ago, but more generally figure out how to do tech-related lending, tech-based lending without falling on the wrong side of the regulator. I think that's the main regulatory interface, I would say, worries us as an investor with regards to Bajaj Finance.
When something is moving so fast, it's hard to contain it. And many times it's after the fact, or it's a constant back and forth and checks and balances system.
And I think just on that, from what I can see, the regulator is deliberately focusing on the fast growing lenders, because the regulator is saying, I've only got so much bandwidth. If you're a big lender and growing fast, I'm going to spend a lot of time looking at what you're doing. And that's where I think the flashpoints potentially will occur in the years to come.
Seems like a reasonable strategy as well from a regulatory standpoint. Focus your time on where there is the most impact. I think you've outlined the growth pockets well throughout the conversation, but if you were to summarize a 5-year, 10-year outlook in terms of whether it's growth in certain business lines or just general market opportunities, how would you summarize those?
So let me just give you the overall growth number. The Indian economy is growing at around 12%. I reckon credit outstanding in the country will grow at roughly 15% for the next decade or so. Remember, Bajaj Finance's share is 1.5% of that credit pie. So I don't see why they shouldn't be able to grow at close to 25%. Lower than their long-term norm of 30, but I think 25% is a very respectable number. I reckon they'll become 10x their size in 10 years hence, right? Now, where will they find that growth? There are still several chunky niches in Indian lending where Bajaj has no presence as yet. So, for example, gold loan finance. After China, we are the largest buyers of gold in the world. Something like, I would say, 10% of Indian families' balance sheet will be gold. Indian families probably own the best part of $1 trillion of gold. And financing based on gold is a big industry. Bajaj should get its fair share of that. Similarly, tractor finance. 60% of the Indian population lives on the farm. They need to make agriculture more productive to feed more mouths. Tractor finance, therefore, becomes a natural area of growth. So in filling in these niches where they historically haven't participated, plus growing home loans and corporate loans and consumer durable loans should give them 25% loan growth. Alongside that, the digital lending piece kicks in. You raised the question as to how meaningful is digital lending. I don't think it's particularly meaningful so far, but those app downloads are soon going to push towards the 100 million mark. I'm pretty sure they'll go through 100 million app downloads in the next couple of years. As that happens, I think the digital lending piece takes off. That again becomes a spur to their growth. And the last piece is that payment app and the use of that payment app for data mining. It's roughly 25 million people use the Bajaj Finance payment app. Now, just imagine the ton of data that Bajaj is getting. Now, where is this guy going? How much is he spending on hotels, on e-commerce, on restaurants, clothes? What sort of customer is it? How can I profile them, right? That's just a mine of data that will get transferred into lending. So this company's ability to take modern technology, marry it with India's needs and generate loan growth without high credit costs is the core engine. And I think the next 10 years bode well for this firm.
On the other side of the spectrum, you talked about the regulatory risks. Are there other risks that stand out to you for this business?
I think the main risk that worries us beyond the regulatory risk, the main risk that worries us is Rajiv Jain. And he's a Superman figure for Bajaj Finance, but he is 56 years old. I think he works a 12-hour day quite comfortably at the moment. He probably does a 70-hour week. He's 56 years old. I think 3 to 5 years hence, he will probably move into a non-exec role. They have identified the successor. We've met him. He's very capable. He's been at Bajaj Finance for a long period of time. He speaks a lot like Rajiv. I won't give his name away, but the successor is in a way a Rajiv clone. But I do worry about the succession because Rajiv's been an exceptional CEO and he'll be a hard act to follow. The other aspect, right, is as you get bigger and you start going into these niches such as, say, tractor finance and gold finance, there is a risk that you go into areas which are politically sensitive. So gold finance can be as little as $300, $400, and you're going into stratas of Indian society where low middle class people are involved. And we are a democracy, and a natural way for politicians to cultivate publicity, cultivate favor with voters is to say, I now announce a loan waiver. How long before Bajaj Finance enters politically tricky areas where powerful people will be incentivized to announce loan waivers? I worry about that. At the moment, those risks seem far away, but for investors like us, the job is to worry about risks that others can't see. And Rajiv Jain, the Reserve Bank of India, and the interplay of Bajaj Finance's burgeoning growth with India's lower income strata is something that we're keeping a careful eye on.
This has been an incredible conversation just in the sense that we've gotten a lot on BFL, but also just the economic dynamics in India, which is always great to learn about, both the macro and the micro. You know, we close these episodes out talking about the lessons that you can take away from this business. What would you point to in terms of lessons from Bajaj?
So let me do one financial lesson around money and how compounding works and one non-financial lesson. The compounding lesson that I learned, and I literally learned this live watching this company compound 1000x over 16 years, is if you're able to raise money at 8 times price. So Bajaj has raised money 4 times in the last decade at 8 times price to book, basically getting very cheap funding from your shareholders. If you then take that money that you're getting cheap equity from shareholders at an incredibly high valuation, and you're reinvesting that at 22% ROE, you are moving that flywheel really fast. That virtuous cycle, raise money at very low cost of equity, generate very high ROE in that, and keep spinning that wheel faster and faster. I'd read about it theoretically in William Thorndike's Outsiders. I see it in motion in Bajaj Finance. That's the real secret to the 32% book value per share CAGR that this company's given in the last decade. On the non-financial lesson, I remember meeting Sanjeev Bajaj 6 years ago. We were sitting in his office and I asked him, why don't you do lots of other things? Other Indian conglomerates do a range of things. They get into real estate, they get into telecom, they get into IT services. Why don't you do that? So Sanjeev said something which has stayed with me. He said that, look, there's only so many hours in a day and I don't want to do dozens of different businesses like the Tatas or the Mahindras do. I want to focus on building scale and excellence in a couple of areas where I think I can make a difference. And he said, I focus on 3 things. And the 3 things that Sanjeev Bajaj focuses on are disruptive innovation, excellence alongside scale, and long-term sustained profitability. And he said, I'll only enter those businesses, Saurabh, where I can pull off those 3 things: disruptive innovation, excellence alongside scale, and long-term sustainable profitability. And as my colleagues and I try to build Marcellus, those 3 things keep sort of spinning through my head, that don't do anything where you can't hit those 3 bullets straight off the bat. And I know one of the reasons I think the business has been so successful is while Rajiv has manned the engine room and navigated Bajaj Finance, Sanjeev has provided the owners, we call it in India, the promoters, clarity of thought that, look, this is what we're going to do. We are in it for the long haul and we're not going to spray capital about in 20 different directions. I think that's a big learning for me. Focus your time and attention on a few things rather than trying to do plenty of things.
Yes, I think I was alluding to the focus point, and you put it in great terms there, great perspective there. Both of those lessons are excellent. Saurabh, thank you so much for joining us. Appreciate you coming back for a round 2.
Thank you, Matt. And if I don't mind my saying so at the parting, my employer, Marcellus, has Bajaj Finance in its portfolio. I'm a client of Marcellus, so are my parents. So by default, therefore, all of us in the family have a beneficial interest in Bajaj Finance. Thank you so much for giving me an opportunity to articulate that beneficial interest.
Absolutely. Appreciate you adding that additional disclaimer there. Thank you very much. Hope to have you back again for round 3.
Thank you very much. Looking forward to that.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JOINCOLOSSUS.com.
A quick note before you go. If you are a company hiring or a candidate looking for your next opportunity, make sure to check out joincolossus.com/recruiting. We launched our recruiting efforts at the end of last year. We started working with firms that were interested in tapping into our audience. And after seeing some early success, we want to open this up to additional firms and to candidates who are proactively looking for their next opportunity. So we are mostly revolving around the investment world and the tech industry. But again, make sure to check out joincolossus.com/recruiting for more information.